Welcome to ETF TV, your insight into the world of exchange-traded funds, issuers, and investments. I'm Margareta Hricova, and joining me today are Frank Koudelka, Senior Vice President, ETF Product Solutions at State Street, and Deborah Fuhr. This is part 2 of our conversation with Frank, where we explore how ETFs have proven the resilience, how the industry is evolving globally, and what lies ahead. Frank, Debbie, welcome to the show.
Thank you very much. I appreciate it.
So regulation has both enabled and constrained innovation. Which regulatory decisions most helped ETFs scale globally, and which slowed progress unnecessarily?
So I'd say anytime a regulator has decided that transparency was key, that actually created an increase to ETF adoption. So you think about Australia, FOFA, the Future of Financial Advice, which eliminated retrocessions, embedded commissions, and anything around pay for play. That really gravitated investors, advisors more towards the ETF as an investment structure. CRM2 in Canada, Client Relationship Model Review 2, where advisors had to disclose the cost of an investment and performance after fees. And that gravitated investors to ETFs that stripped away a lot of, again, those embedded or hidden costs. MiFID II in Europe, eliminating some of the conflicts with retrocessions. Again, a bigger push towards ETF as a result. So that all led to, I think, the expansion and growth of ETFs. As far as slowing progress, again, I get back to that point on active. If you look at some of the markets today, like Asia, we're starting to see a big uptick in active. Well, certain markets still have a lot of restrictions. So you think China, you have to have a lot of correlation to an index. So you only have like 20% of the portfolio can actually be actively managed. So I think that's a constrainer to true active management in the market. And we've heard some indications that that might be changing, which I think would ultimately be a good thing. South Korea, the same. You have to, in a sense, their active is more passive plus or active light. So again, there's a lot of correlation to an index. So I think when the regulators decide that they're not going to put a constraint, that's where you see the most innovation and that's where you see the most growth. So that's where I think that ultimately those markets will go because they've seen some of the success we've had in North America, we're starting to see in Europe, and they're going to want to see the same for their broader markets. So I think they'll loosen up some of those regulations.
Yeah, I agree. I think you mentioned Canada, so I should give a shout out that Canada did launch the first ETF because many people in the US think it was the US. And so Canada launched their first ETF March 9th, 1990. US came 3 years later, but many people see the US as driving the ETF industry. And it's primarily because 70% of the assets sit there. So when you think about the US, and we move beyond it, how different is global ETF success from the US-centric playbook that people have been working off of?
I think it's a great question because the US is a monolithic market, and in a sense, you know who the distribution channel is, you know who the main buyers are. Whereas if you start to expand globally, every market is different. You have a extreme bent in Europe to institutional investors. It's changing. It's getting more retail with the ETF savings plans. But if you don't have a strategy around the institutional market and you don't have a strategy country by country because the buyers differ country by country, you're going to struggle to have a successful ETF strategy. Even though they're covered by the UCITS umbrella, you still have to have a completely different distribution strategy within the continent of Europe. Then you go to Asia and you have 15 different ETF markets with 15 different sets of rules, 15 different types of buyers. So again, you have to be very thoughtful as to what markets do you want to play in, what regulatory regimes line up to the strategies that you want to launch, and what buyers actually line up. You want to go out to a retail heavy marketplace. Well, you might want to look at South Korea and the Taiwan market. You want to go more institutional. You might want to think about maybe Hong Kong as a market. So every market that you move around globally, you have to think of number one, the regulatory regime and what does it allow what doesn't it allow? And number two, who are the buyers and how do you get at that distribution channel?
Do you have any thoughts on the Middle East and Latin America? Because those are kind of up and coming areas.
I think Latin America today, at least, the ability to leverage that market through the UCITS umbrella has been, I think, a significant enabler. It's actually a pretty significant ETF market, just not a significant local ETF market. So if you have a strategy, especially to get at the pension schemes, you probably want to do it through either the UCITS umbrella or utilizing the 40 Act structures and selling those into those pension schemes. I think the Middle East, the sky's the limit. I think there's a lot of built up wealth. There's a lot of desire to invest. And I think ETFs are the perfect vehicle. You know, State Street definitely wants to participate in that market. We've been studying it pretty closely, and we think that there's a lot of growth potential there.
Looking ahead, which part of the ETF value chain is most likely to be disrupted over the next 5 years and why?
Well, that's a good question. I keep hearing these 5 year increments, and ETFs keep punching above those 5 years. So I think the product type that I keep hearing about, and it seems to be dissipating a little bit, is direct indexing, and that's going to disintermediate a lot of ETF investing because you can, kind of hone the strategy to your own desires. If you're an impact investor and you want to screen out certain names, you could do it. I just don't see that as being something that's going to happen at scale. I know computing power continues to improve. You can drive down the cost of doing direct indexing. I still think that the use case for ETFs supersedes direct indexing. So I'll take that one off the table for now. And then I'd say tokenization, but I just don't think if it's 5 years out. I think it might be longer. And I look at tokenization as two different phases. The first is here, which means I'm going to create a tokenized share class of an ETF, and I'm going to go after digital native investors and broaden distribution. I think that's real. We've seen it Hong Kong. We've seen a use case there. We've actually seen some derivative products not made by the manufacturers, but made by digital native firms to tokenize products in Europe as well. So that's real. But I think the area that potentially can completely disintermediate the market is full tokenization. So you skip the ETF as an investment wrapper, you tokenize your investment completely on digital rails. That has the ability to disintermediate a lot of the market. You'd think traditional exchanges that trade ETFs, they're potentially eliminated and you're going to digital native exchanges. You think of depositories and clearinghouses, you're going to atomic settlement on chain. You don't necessarily need those types of entities. You think of custodians as service providers potentially being disintermediated. So I think that has a use case further down the road. I don't know what it's going to look like. It's going to be beyond my retirement, thankfully. But I think the regulators will have a say there because you also have the ability by going to things like digital with bad actors coming into play. So there's cases where regulations actually make sense. So I think tokenization is real. There's two different use cases. Number one is happening today. Number two, I think, is further into the distance. But I think the regulatory environment is going to be country by country deciding what can and can't happen there.
It's an interesting answer. If you think back over your career, there's been a lot of interesting debates, decisions, industry trends that have happened. Thinking now, are there any that you would like to view differently than you did at the time?
I'm going to take a different angle on the question. I'm going to answer it the way I want to answer it. I think we were very early at State Street and personally seeing the pivot to ETFs as a vehicle as opposed to a passive vehicle. That thinking that active managers can participate back in the 2010s, we were talking about this whole concept of ETF 3.0, which is active management. And the reason we were so bullish on it was, like ETF was a delivery vehicle that was modernized. It was taking something that was very successful. Mutual funds have had a 100-year history and modernizing it to where the current investors are. And I look at my background first on the broker-dealer side of the business, then on the depository side of the business, and then as a mutual fund transfer agent and service provider. And early days, I said, boy, ETFs would solve a lot of the problems mutual funds have. When I was on the broker-dealer side, we built our platforms around equities, and ETFs are built around equities. So mutual funds created a lot of friction on a brokerage platform. ETFs eliminate that friction, so it makes it easier to hold and trade. And then I think about clearinghouses, they were really built for equity and fixed income securities. Mutual funds became a side experiment that they utilized to create a lot more efficiency, but the systems themselves were really built for equities. And again, the way that ETFs were designed fixed a lot of the problems that mutual funds have. So I'd say we were really early adopters of the whole concept that ETF's a delivery vehicle. It's not a passive vehicle. Open up the whole marketplace to it, and I think it's good because it creates a lot more competition, creates a lot more investor choice, and ultimately, I think that's good for the industry.
As you step back, what is the one principle that next generation of ETF leaders must never lose sight of?
Yeah, I think it's being nimble and being innovative. So we can't put ETFs in boxes. We have to continue to expand the use case. So I think today, we're putting, private credit, pre-IPO companies into them, private market strategies. I think we continue to expand the use case. You think of all the option strategies that are driving more income to portfolios, which is important for those that are on like a fixed income and they are trying to make sure that they have a means to meet their monthly obligations. Buffered products or downside protection. You could participate in the market, but not with all the downside risk. These are all innovations that have taken place within the ETF market just in the last 10 years. And I think that's going to continue because I think more and more we're going to embrace the concept that it's a way to deliver different types of outcomes within a portfolio in a more elegant manner to the masses. And I think if we stay nimble, we stay innovative, ETFs are going to continue to grow the way they've grown over the last 30 years.
I guess one question that is on the tip of everyone's tongue, is there a next chapter for Frank, or what is next?
So I think it's going to be a lot of time with the family, doing this global role for State Street. I've loved it. I love the industry. I love all of the colleagues that I've made in the industry, but it takes away family time. So spending time with my wife Lorraine and my 11 grandkids, I think, and obviously my kids and my daughter-in-laws as well, is going to be time well spent. But I'm sure there'll be other chapters somewhere in the ETF industry that I'll show up. But for now, it's going to be a lot of family time.
That's great. And personally, I'd like to thank you because you've been a real supporter of me and the company and everything we've been doing over the years. So we wish you all the enjoyment you can have with your family and look forward to seeing you pop up in different venues in the future. Thank you.
Thank you.
Thank you so much, Frank. And thank you to all of you for watching. To watch prior episodes and to stay up to date with the latest in the ETF industry, visit us at etftv.net. Thank you.